Hello guys, today we are going to talk about loans. Taking a loan is borrowing money from the bank for individual use. This is when you go to banks or lenders and ask them if they can give you some money which you can use for your businesses, individual use. You can go for shopping, vacation, such things with that money, or invest in your business to grow your business or to start a business. Now, when you borrow the money, you have to pay back to the bank after a certain period of time. You will talk to your lender and they will give you an interest rate which determines the amount of money in total you'll pay back to the bank. Because when you take the loan, let's say $100, you'll pay them back the $100 and an interest will be charged to that amount. Now the interest is the money the bank makes from giving you the loan. So at the end of the loan period, you pay back the principal amount, the amount given, plus the interest. Please note the average net worth of people, most of these people around the globe, is $500. One in every two people have $500 saved up in their bank accounts. Now, when going for a loan, the bank will check your credit score. The credit score is what they determine to use, is what they use to determine how much money they are going to give you, how much money you can be able to pay them back, and it also determines how much interest they are going to charge you. Now, the credit score is determined by the amount of credit that you use in your savings or banking or checking account. It determines how much or how big a loan you will get from the bank. The credit score is determined by the amount of money you spend on transactions and the number of transactions you've done. It also considers money that you have saved in the bank. That is the money that you have allocated to your financial portfolio. They use the credit score to determine if you can or how well you can be able to pay back the loan that is given by the bank to you. Now you can ask the bank to give you a credit score, a credit rating, or you can go online and check CRB apps that will calculate your credit score and tell you how much it is and what amount you can qualify for when you go for a loan. Go to lenders like banks, credit card services, and loan apps to see if you qualify for a loan. Online, you can easily get soft loans from loan apps. Sign up for credit cards. After using them for a while, they will give you a chance to borrow money from them. And banks also open bank accounts and start saving money in them. And after using the bank account for a while, you'll be able to qualify for a loan. Now, when you get a credit card, use it to pay what you would otherwise pay for in cash, so that you can build your credit score by having transactions in your credit card. Also save money in the bank, because the more money you save in a bank account, the higher the loan you can qualify for. Now, when you get a loan from the bank, you're supposed to make repayments for that loan. It depends on how long the loan you've taken is for, and you can either repay it for a set number of months. Let's say after 3 months you're supposed to pay the whole loan, or even after 6 months you should make sure you've paid the whole loan. Now, these loan repayments are usually done every month. Soft loans you have to pay most of the time from 1 month to 6 months. And make sure you make these loan repayments on time, so that you are not disqualified from loan programs. Now, if you have to pay a certain amount of money to the loan provider by the end of the month, make sure you pay it, so that you are able to borrow more money from them. As you pay your monthly repayments, also make sure you are not CRB listed by making the payments on time. Now, when you get loans from different providers, there are very many ways you can pay these loans. Today I'll tell you about two methods of repaying back loans. There is the avalanche method and the snowball method. Let's start with the snowball method. In the snowball method of paying back loans, you start with the smallest debt first. You pay it, you go to other smaller debts. As you continue paying as you move on to pay the bigger debts last, you pay the larger debts last in the snowball method. Now, in the avalanche method, you pay big debt first, then you proceed to pay the smaller debts next, followed by the smallest debt that you have last. That's it for today, guys. Like, subscribe, and comment below. Like, so that my video is shared to more people. I'll see you next time. Thank you.